The stock for Minerva Neurosciences Inc., NERV, is trading live right now at $9.94, showing an absolutely massive intraday increase of plus 273.67%. This extraordinary, almost unheard-of surge follows a market close yesterday at $2.66, which means this clinical-stage biopharmaceutical company has essentially quadrupled its market value in a matter of hours. This is not a slight uptick or a small percentage gain, this is a vertical move, and that fact alone should immediately draw a sharp line between typical low-float biotech stock speculation and a genuinely significant capital-altering corporate event. The immediate insight, the angle you probably didn't see coming, is the quality and scale of the institutional backing tied to this spectacular rise. It's not just a retail trading frenzy. Yesterday's closing bell, which most investors would have considered the final chapter of a year filled with regulatory setbacks and cash burn anxiety, was actually the quiet before the financial storm. The expectation for Minerva has been, frankly, quite muted and skeptical. The general market narrative around Minerva Neurosciences for the past year has been dominated by the ghost of the complete response letter from the FDA concerning roluperidone, their lead product candidate for treating negative symptoms in schizophrenia. This disappointment forced the company to concede that a new confirmatory Phase 3 trial would be required, a huge setback that reset the timeline and amplified the company's capital risk. Investors had been focused on the chronic cash burn, the painful reduction in R&D and G&A expenses designed to keep the lights on, and the general air of a small biotech in a holding pattern desperately seeking the funding to execute a massive, multi-year clinical trial. The market's expectation was a slow, grinding process of dilution or a difficult hunt for a corporate partner. The reality that hit the wire this morning utterly shattered that expectation. The company announced it has secured up to $200 million in private placement financing led by Vivo Capital LLC, with participation from major established institutional investors like Janus Henderson and Federated Hermes Kaufman Funds, among others. When you see names like that stepping in to fund a biotech's Phase 3 trial, an expensive, high-risk proposition, it's a profound vote of confidence that goes far beyond a simple stock offering. It signals that sophisticated capital believes in the drug, the management's new direction, and the commercial viability of the market opportunity enough to front a nine-figure sum. This is why the stock price is where it is. The specter of immediate financial ruin has been lifted, replaced by a fully funded path to NDA resubmission and potentially commercial launch. The dramatic spike in volume, saying tens of millions of shares traded this morning compared to an average of under a million, confirms that the street is aggressively repricing this security. The core of Minerva's business, the engine that powers this incredible stock movement, is roluperidone, which targets a significant unmet medical need, the negative symptoms of schizophrenia. These symptoms, things like blunted affect, social withdrawal, and lack of motivation, are notoriously difficult to treat, and current antipsychotic medications often fail to address them effectively or introduce debilitating side effects. Roluperidone is a distinct compound, a 5-HT1A and sigma-2 receptor antagonist, and the hypothesis is that its mechanism of action can treat the negative symptoms without causing the motor-related or metabolic side effects often associated with standard dopamine receptor-blocking antipsychotics. For years, this was the central, high-risk, high-reward bet. The original Phase 3 trial data, while statistically complex and leading to the CRL, contained hints of efficacy, which kept the flicker of hope alive. The FDA's requirement was not a final rejection of the drug itself, but a demand for a stronger confirmatory study. The expectation had been a slow, arduous capital raise that would lead to significant shareholder dilution at depressed prices, which many individual brokerage holders, perhaps using Robinhood stock trading for quick access or utilizing a basic invest online approach, were dreading. However, this private placement of Series A preferred stock and accompanying warrants drastically changes that equation. The upfront $80 million secures the funding for the upsized confirmatory Phase 3 trial and NDA resubmission process, which the company has already aligned with the FDA on the design for. The additional potential $120 million through Tranche A and Tranche B warrants tied to certain milestones provides a financial runway for potential U.S. commercial launch preparations, should the trial succeed and the drug get approved. This is an all-in bet by major institutions, transforming Minerva's balance sheet overnight from one of precariousness to one of strength sufficient to execute its primary mission. The financing also comes with a corporate governance shift, as the company will increase the size of its board and appoint up to 3 new directors expected to have significant schizophrenia clinical trial experience, a clear move to strengthen clinical operations and demonstrate institutional commitment to successful execution. The institutional activity surrounding this deal is key. When you look at the names involved, investors who do deep due diligence, often much more detailed than what you get from a retail online investment platform, it provides a crucial piece of the puzzle. They are not merely gambling. They have calculated the market potential for a drug that could effectively treat negative symptoms of schizophrenia, a market that has been largely untapped. This contrasts sharply with the average retail investor's perception, which likely sees Minerva as a volatile, speculative, microcap biotech on life support. The common belief was that the dilution would be crippling, but the funding terms, while involving warrants that could lead to dilution later, are structured to give the company the capital it needs now to create future value. The immediate focus for the stock's future movement will be on the execution of this new confirmatory trial. Biotech stocks are driven by binary events, and this massive influx of capital transforms the next major binary event from will they be able to fund the trial to will the trial succeed. The clock is ticking, and every news release detailing the trial's enrollment progress, interim safety updates, or administrative changes will create volatility. Given the typical timeline for a Phase 3 trial in this space, we're looking at a multi-year effort before definitive top-line data arrives. However, the stock price has already discounted a successful funding and a credible path forward. The volume, the quick move off the lows, and the sheer magnitude of the daily swing all point to a complete reversal of sentiment. This is an example of how a catastrophic corporate event, the CRL, can be completely overturned by a successful and substantial financial maneuver. Looking at the broader context of online investing and how platforms like SoFi Invest or Robinhood have democratized access to these highly volatile securities, it's important to understand the mechanics of this surge. Low-float stocks, which Minerva is, with a relatively small number of shares available for public trading, tend to have exaggerated moves on significant news. The massive institutional purchase this morning essentially vacuumed up a large percentage of the available shares, creating a supply shock that forced the price upward dramatically. Anyone holding the stock from yesterday is sitting on a huge paper gain, while anyone shorting the stock is facing a significant, painful squeeze. This type of price action is less about the fundamentals of the treatment today and more about the suddenly solid financial foundation to pursue the regulatory process tomorrow. It is a massive decompression of the risk premium that had been built into the stock price due to liquidity and financing fears. The question for anyone holding or considering this stock now, whether through an individual brokerage account or a more sophisticated platform like Interactive Brokers, is whether the drug's probability of success has increased by the same magnitude as the stock price. The funding simply makes the trial possible. It doesn't make it a guaranteed success. That distinction is crucial. The market is now pricing in a much higher probability of success because the trial will happen. The next steps will involve the appointment of those new board members and the finalization of the Phase 3 protocol, which the company has confirmed aligns with FDA requirements. Minerva Neurosciences is primarily a clinical stage entity, which means it generates minimal to no product revenue and operates at a loss, typical of the biotech sector. Its financial health is best measured by its cash runway and burn rate, which this new financing has critically addressed. Historically, the company has successfully out-licensed certain assets, like seltorexon, to Janssen Pharmaceutica NV, which provided non-dilutive capital and potential future milestones, showing their capability in managing their pipeline. That original deal provided a lifeline in the past. Their continued focus on central nervous system disorders, which are notoriously difficult drug targets but offer immense commercial reward if successful, defines their business model. They are a pure-play bet on roluperidone and their smaller, earlier-stage asset, MIN-301, for Parkinson's disease. The recent financial reports have shown a concerted effort to slash R&D and G&A to conserve capital, a sign of a company managing scarcity. But this new funding will reverse that trend as they ramp up for the confirmatory trial. The long-term outlook hinges on the trial's outcome. If roluperidone is approved, it targets a market worth billions as negative symptoms of schizophrenia affect millions globally and current treatment options